Revenue recognition rules provide guidelines on when and how a company should recognize revenue from its sales transactions. These rules are important for ensuring that financial statements accurately reflect a company's financial performance and for standardizing accounting practices across industries. The Financial Accounting Standards Board, FOSB, introduced a new revenue recognition standard known as Revenue from Contracts with Customers for fiscal years beginning after December 15, 2021. This standard, also known as ASC 606 in the United States, and its international counterpart, IFRS 15, provide a comprehensive framework for revenue recognition, including multi-element arrangements and revenue recognition in the cloud. Under the new standard, companies under contract to provide goods or services to a customer will be required to follow a 5-step process to recognize revenue. The first step is to determine whether you have a contract. Next, you need to identify the performance obligations. Then you would determine the transaction price. After that, you are ready to allocate the transaction price. And finally, you would be able to recognize revenue as performance obligations are satisfied. These 5 steps might seem straightforward, but the reality is that revenue recognition is very complex. Many companies, especially those in computer software, subscriptions, and hardware, have an entire separate team that just manages revenue recognitions and arrangements. We'll take a closer look now at revenue recognition for multi-element arrangements. A multi-element revenue arrangement is a type of sales or service contract in which a company agrees to provide multiple distinct goods or services to a customer. These distinct elements, often referred to as performance obligations, are separate items, products, or services that have standalone value and can be sold or provided separately. In a multi-element arrangement, the customer typically pays a bundled price for the entire package of goods or services, which may vary from the standalone selling prices of the individual elements. Examples of multi-element revenue arrangements include software licenses with ongoing maintenance and support, contracts for the delivery of customized products with installation services, and service agreements that include multiple services bundled together. The first step in applying the 5 revenue recognition steps to a multi-element arrangement is to identify the contract with a customer. Contracts may be written, oral, or implied by customary business practices. However, ideally the contract would be in writing. Companies then need to identify distinct performance obligations within the contract. A performance obligation is a promise to transfer a distinct good or service. That might be software, maintenance, a discount promise for the next release, and a hardware component. Next, the total transaction price is determined, which includes the consideration the company expects to receive in exchange for transferring goods or services. Now you are ready to allocate the transaction price to each performance obligation based on its standalone selling price. If standalone prices are not readily available, estimation techniques may be used. However, that can be a big discussion point with auditors. What if the company promised a 20% discount on the next product release but that release hasn't been priced out yet? Next, revenue is recognized when each performance obligation is satisfied. This can occur at a point in time or over time, depending on the nature of the obligation and specific criteria outlined in ASC 606 or IFRS 15. Constraints may be applied if there is uncertainty around collectibility or other factors affecting the recognition of revenue. Revenue in the cloud refers to the income generated by companies that provide cloud computing services and related offerings to their customers. Cloud computing enables the delivery of various IT resources, including computing power, storage, databases, software applications, and other services over the Internet. Companies that offer cloud services typically generate revenues through various models, such as subscription-based services, usage-based pricing, and one-time fees for specific services. Let's now review the different types of cloud revenue and the related accounting treatment. For subscription-based cloud services, revenue is typically recognized over the service period as the customer obtains access to and benefits from the service. This aligns with the transfer of control concept in ASC 606 and IFRS 15. In cases where customers are billed based on usage, for example for data storage, data transfer, computing power, revenue is recognized as the customer consumes the service, provided that the company has transferred control over the service to the customer. Non-refundable upfront fees are recognized as revenue when the company satisfies the related performance obligation or, if applicable, over the service period. Changes to cloud service contracts are evaluated to determine whether they represent a new contract or a modification to an existing contract. Revenue adjustments are made accordingly. Service level agreements that provide for credits or refunds due to service interruptions or underperformance are considered in the revenue recognition process. These potential future obligations may affect the transaction price and revenue recognition pattern. The adoption of ASC 606 or IFRS 15 has resulted in a more consistent and principle-based approach to revenue recognition. Companies in the cloud computing industry, as well as those with multi-element arrangements, must carefully assess their contracts and revenue streams to ensure compliance with these standards. Compliance often involves evaluating the timing and pattern of revenue recognition, disclosures, and ongoing assessment of contract modifications and performance obligations. Consulting with accounting professionals knowledgeable about ASC 606 or IFRS 15 is essential for proper implementation and compliance.